Hello folks, Steve Lentz here with Discover Options here at Option View. Welcome to this presentation of market timing reports for advanced options traders. This will be for Friday, November 3rd, 2017, getting ready for Monday. Let's see, it will be the, 3rd, 4th, 5th, 6th. I usually do this a day later, so I'm trying to get my bearings here. So Monday, November 6th, presented material today is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get started, I want to make sure you know you can get a free ebook, Simple Steps to Options Trading Success. Simply click on the link, give us your information. We'll get that free ebook out to you. Also, we'd appreciate it if you were to subscribe. That way you can get a notification whenever we post new videos. Now, we have 3 market timing reports for you: the Condor Butterfly Timing Report, the Bull Put Spread Timing Report, and then the Directional Likelihood Report, all 3 for the S&P 500. In all 3 reports, we look at the market condition that you see here, and we define market condition in 3 different dimensions: price action, trend, and then the stochastic situation. In terms of price action, we had a downswing bar on Thursday and then an upswing bar on Friday, with a higher high and higher low on Friday. That price action occurred in the context of an uptrend where the close is well above the 50-day simple moving average. And then all of that is occurring in a situation in the 15-3 stochastic where we are between 65 and 100, kind of in overbought territory, and the stochastic is trending above its 3-day simple moving average, or the %D. All that makes up for a market condition combined, a 3-dimensional market condition that's occurred roughly 86 times in the past, from Jan of 2000 up till the present in the S&P 500. So it has not occurred that often, but when it has, we have some good solid statistics to look back and answer the questions posed by these 3 different market reports. So let's go to the first one. The Condor Butterfly Timing Report answers the question: is now a good time to start a condor or butterfly campaign in the S&P 500s? So here's how the report goes. So since January, we've had over 4,500 daily closes of the S&P 500. Of these 4,500, 65.6% have been favorable bars for selling options premium where the actual subsequent 21 bar movement was less than the movement implied by the SIBO skew adjusted implied volatility, or the VIX. Okay, so once again, 65% of the bars turned out favorable where the actual movement was less than what was implied by the option prices. Okay, that's a favorable situation. It happened about 2/3 of the time. 1/3 of the time, it was unfavorable, where the actual movement was more than what was being implied. Okay, so that's the baseline we want to remember. Now, during that time, our market condition occurred 85 times. Of those 85 occurrences, 57.6% of those were favorable for premium selling. Okay, far less than the benchmark of 2/3 about. So this implies an option premium selling edge that's negative, about 8% negative edge. All right, so does it mean that if you do a Condor Butterfly campaign that it's going to lose? No, it just means that it's more likely than normal that you will encounter some choppy waters in terms of the market being more volatile than what is being implied by the option prices through the skew-adjusted VIX there. Okay, so that's the Condor Butterfly Timing Report, a negative edge, fairly significant right now. Let's go to the Bull Put Spread Timing Report. This is for those of you that like to trade from a bullish perspective. Maybe you're leaning Condors bullish. Maybe you're just flat out doing credit spreads in the S&P 500. But this is predicated on selling put premium 30 days out, roughly a standard deviation away. Okay, so as I mentioned, since Jan of 2000, we've had roughly 4,500 closes of the SPX. Now, of those, 83.1% have been favorable for selling that out of the money put premium 30 days out, a standard deviation away, where the actual downside movement was less than what was being implied by the skew-adjusted VIX. Okay, so 83% of the time, the market does not move that full standard deviation down over 30 days. Okie dokie. So the other 16.9% of the time, it does move down that far. So if you're looking for it to strike your, hit your short strike down there, and you put it a standard deviation away 30 days out, 16.9% of the time on average, it does do that. Now, let's look at our market conditions. So our market condition has occurred 85 times. Now, of those 85 times, 76.4% of the time, the bars were similarly favorable. Okay, so 23.6% of the time, it actually moves and hits that short strike down there, a standard deviation away. So this implies a selling edge, a bull put spread selling edge that's negative, minus 6.7. So it's not as good a time as normal to put on these bull put spreads. Statistically, then, it's more likely than usual that Friday's bar will end up being one that's unfavorable for selling out of the money put premium. All right, so that's that for the bull put spread. Let's go to just the straight market likelihood report. And this answers the question, based upon past occurrences of the current market condition, what is the market likely to do? Go up, down, wobble around a bit, etc. And to answer that question, we use what's called price distribution bands. Distribution bands, where we're trying to look at price distribution and measure it, and then and I'll show you how we do that here. So let's take some 5-day bands. I go out a standard deviation from the close, 5 days out, one standard deviation to the upside and to the downside. Now notice that the upside band is a lot closer to the downside band. That's because the out-of-the-money call premium the out-of-the-money calls have lower implied volatilities than the out-of-the-money puts that have higher implied volatilities. So that's why you have this asymmetrical nature to these bands here. Okay, and what we do is we look and see whether or not for each close the market moves up and hits the upper band, goes down and hits the lower band, or wobbles around and doesn't hit either of them. So let's run the statistics on all the closes. And we do this not only for the 5-day bands, but the 10 and the 15-day bands as well. And we keep statistics on all 3 bands, both to the upside and the downside. So when you go to the report, come up here, you'll see the benchmark out of 4,508 occurrences. All right, the upper bands get struck 21.3% of the time. The upper 10-day band's 15.8, the upper 15, 14.9. On the lower side, underneath the close, the lower 5-day band gets hit 16.5, 16.7, and then 19.5% of the time. Now, of our 86 occurrences, we can see that all 3 of the upper bands get struck far less often, only 8% versus 21.3, 11.6% versus the baseline of 15.8, 10.5 versus 14.9. So a big difference on the upside bands. They do not get struck near as often. Okay, when our market condition develops, the upside bands get struck less often. Does it mean they never get struck? No, they get struck, roughly 10% of the time, which is less than normal. Now, on the downside bands, these bands are getting struck much closer to the baseline here. In fact, on the lower 10-day band, just a little bit squeege above normal. But on the lower bands, they're getting struck pretty darn close to normal versus the upside bands. And when we break this 86 out, okay, and we look at the action on Monday coming up, okay, if price exceeds Friday's high, you can see similarly the upper bands get struck way less often. The lower bands get struck a bit more often, especially the 15-day band getting struck a third of the time there. And if price exceeds below the low of Friday, you could see in that case, similarly, the upper 5-day the upper bands get struck less often. All 3 of the lower bands are struck more often if in this case Friday's low gets exceeded. Okay, 21, 17, and 21% of the time. Okay, so what you see here is a picture that would lean a little bit to the bearish side where the bearish bands are getting struck a bit more often in these scenarios. And in all these cases, the upper bands are getting struck less often. So again, this is more of a bearish leaning situation here. If we were to look at the past, extrapolate to the future, there's a likelihood of bearishness coming up over the next 5, 10, 15 trading days, okay? All right, so let me click this. Here we go, click, click, click. No, escape. There we go. That's it. Folks, thanks for joining us. I'm Steve Lentz with Discover Options. Have a great week trading. We'll talk to you later. Bye-bye.